Welcome back. Let's talk about the fund flows now. Equity mutual fund flows have grown to 11,700 crores in March, highest since October 2018. Hybrid funds also continue to see growth for third consecutive month, though there's a bit of a dip, small dip in SIPs to about 8,000 crores. Aashish Somaiyaa, CEO of Motilal Oswal Asset Management, is with us now. Aashish, good morning. So numbers look good, but let's start by nitpicking. This SIP flows, why do you think that's down, even though it's down marginally? Just people postponing or just stopping for 2-3 months ahead of elections?
Yeah, I think, the SIP flows are a function of what people's experience is through the time that they live with their SIPs. And if you see in the last year or couple of years, SIP returns have been quite a challenge, because if you see throughout 2017, you were consistently averaging upwards. So you kept buying, if you had 12 months of SIP in 2017, you kept buying at higher and higher prices. And then suddenly there is like a sharp dip by the time you hit August, September, October 2018. So I think a lot of people have not had a great experience. While 1 or 2 years is not time frame enough for people to make a conclusion, but definitely people react to what kind of returns they are seeing in their account statements. So that 50 crore decline in the monthly input has to be seen more as, larger number of people allowing their SIPs to expire, or even some of them cancelling, more than the number of people who actually came forward and registered new SIPs.
But okay, since you were talking about experience that people have with SIPs, let me tell you mine. It's a big problem stopping an SIP, yaar. They say, ye mahine ka bhi jayega, agla mahina bhi lenge, aur agla mahine ka 10 tarikh tak they will take. I mean, it is very difficult to stop an SIP. So do you think those of us who have stopped our SIP in probably Jan, Feb, March, looking at the markets, will see the impact of the flows in the coming months? You will see it in April and May.
Yeah, so one way to read it is that, if you stop your SIP in January, then maybe one installment goes through in February.
Two of them.
Okay, so on a lighter note, we have an app and you can stop the SIP, but that's not something I want to advertise actually. That's not the way to look at it really.
All right, no, I'm just saying whether there is a follow-through impact. That was my simple question.
Yeah, no, there is actually, because, maybe there is lag time in how people react and when it actually gets actuated. But yes, the sign is that, people are reacting to what is, and, a lot of new registrations have come about in 2016-17. So when the initial starting experience is not that great, then definitely people don't show that kind of confidence anymore. We all know that's not the way to react, but that's a fact that's happening.
Ashish, hi, good morning. I know you don't want to plug in your app, but it's good that you've informed us. A lot of people struggle with these things, so any kind of knowledge is good enough. But I wanted to ask you your views on, there was a big surge in income funds this time around. I mean, almost 13,000 crores came into income funds in March versus almost nothing over the last few months. What's happening there? And overall, what do you see as the trend as we head into the next few months, post-election as well?
So my sense is that, it is some amount of, while income funds is a very, very broad category, so I would not like to generalize, because, other than liquid funds and those fixed maturity plans, pretty much short-term bond funds and medium-term bond funds like 1 year duration, AAA, non-AAA, it's like a very, very broad category, and pretty much everything fits into income funds other than just liquid funds. So I think that's more, a lot of times what happens is that people invest in, say, fixed maturity plans. It is perceived that March end you get reasonably good yields. So if you lock in your money, it crosses a couple of financial years, then you're likely to get better yields. So I think there is generally always a rush for people to capture good yields when the end of March comes. And I would put it more as a year-end phenomena. So, liquid funds see a bit of an outflow, and some of the better yielding funds see a bit of an inflow. That's a year-end phenomena which always happens actually.
Okay. Can you give us some idea of how the flows into debt funds were? How was the experience in March itself? And is that still a spot of bother? This fits and starts that we see of people, of corporates redeeming hugely from liquid funds?
No, I think that sort of, I don't come across that sort of high amount of panic or concern anymore. I think that things are actually stabilizing. And whatever initial reaction had to be there, my sense was more in the end of December quarter and maybe early January at best. But if you see in the last couple of months, kind of normalcy has been returning as far as flows are concerned, as well as far as investors, reactions to things are concerned. There was elevated fear in the end of last quarter, but after that I think things are stabilizing.
Aashish, just stay on. Just let's see the first opening rate on the market. They're all over the place, but the Nifty is flat. The currency has also opened flat. So we'll address rates in a bit. Aashish, you can tell by perhaps your own experience, since you have a multi-cap fund and there are mid-cap funds as well, large-cap funds. Since 2018 was so brutal for mid-caps and broader market, and we saw that trend continue at least in the first quarter or first 2 months of 2019. After that, we've started to see some bit of participation in the mid-caps. In terms of fund categories, equity fund categories, what's been the trend? Is it more large cap specific or multi-cap, mid-caps also seeing fresh inflows?
No, actually, my experience is that, so for our house, I would break it into two parts because we are pretty big in the alternates, the PMS, AIF kind of space. And we are pretty small and mid-cap heavy as far as the PMS space is concerned. So I think there we have seen that, people have done some amount of bottom fishing because, the portfolios are out there in front of them and they know where the money gets deployed. So I think February and March specifically, we have seen some bottom fishing, but I would only stop at calling it bottom fishing. I would not call it like there is a huge surge of flows really. But directly on your question, I think the preference is still, because there is so much of recency bias, the preference still is with large cap or multi-cap kind of products. Also, sometimes instead of being contrarian or counter-cyclical, I see that a lot of industry participants also, move their conversation towards, let's say, okay, last year large cap was good experience with large cap, so let's stick to large cap. I think, if you see counter-cyclically, one would have expected that people would put more money into small and mid-cap on a relative basis, but I think the flows are more focused on large caps and multi-caps at this point in time.
You've seen a preference move further away from balance funds, because for 3 months now we've seen, negative numbers on balance funds. It was negative 1,000 crores in Jan, negative 1,100 crores in Feb, and now a negative 3,200 crores. So people actually pulling out money from balance funds. Do you see that trend continue?
Yeah, I won't be surprised if it continues. The reason being that there has been a series of disappointments in some sense. One is purely related to the psychology, because people think that a balanced fund or a balanced advantage or dynamic, whatever you name it, people think that those, rightly or wrongly, they think that that category should never give negative returns. Whereas I think at some point in time, on a one-year basis, some of those funds had negative returns. Also keep in mind that there is a very normal behavior that, if you have invested 100 rupees, at some point in time you see that the value has become 90, you're not happy about it. Now the moment the market retraces and you are able to get 100 or recoup 100, the first instinct for a lot of people is to pull the money out. So I think balanced funds has 2 or 3 of these things. One is that maybe a recouping of values is letting people just take the capital and get out. The second is maybe a disappointment on the returns. And third is that, there has been a lot of communication about balanced funds giving dividends every month. And I think there have been disappointments there because some people have stopped paying the dividends. That's what I hear. So multiple reasons for the flow in balanced funds.
Okay. I'm sorry, I'm coming back to the debt mutual funds, because for 2 months in a row, the numbers are negative into liquid funds. It is a 51,000 crore outflow for March itself, 51,300 crore. And it follows a 25,000 crore outflow in February. So would you worry? I mean, we still hear IL&FS unresolved. A lot of money is not flowing from some of these debt instruments, extension of tenures for some of the promoter entities. Are you okay with the debt market currently?
So I can assure you one thing, that for example, none of these papers have been populated in any of the liquid funds. So liquid funds, I would honestly say, is like I mentioned before, quarter ends, there are a lot of people who don't want to carry perceivedly capital market instruments or mark-to-market instruments in their balance sheets. So it's very normal for a lot of institutions and corporates not to be in the liquid funds at the end of quarter. So that again is, and I don't think any of the papers that we have been concerned about are lying in the liquid funds at all. Yes, on the other point that you mentioned, like I said, the elevated fear was somewhere in December and early January, but I think now it has been cornered down, or it has been zeroed down to one or two schemes or a couple of areas or even couple of papers in the whole industry. And people have a sense that, okay, this is 1% of this portfolio or 1.5% of that portfolio. So I think the problem has been, whittled down to a pretty narrow pocket. I think a lot of the others which were in fear, I think they have really conducted themselves well and money has been paid back on time. So my sense is that the overall fears have receded, and I hope that, nothing else crops up.
All right. Ashish, thank you very much for joining us with your analysis of the flows. It does look like in equity there isn't too much of a problem. There is still faith. Either it's coming as ELSS or it's coming as directly into equities, and maybe preference for multi-cap funds. But in debt, we will have to wait and see. Actually, that question to you.
Just before
Sandeep,
that, Lata, the pre-opening rates actually have kicked in. So just want to get a couple of rates in. The market, the Sensex and the Nifty have opened absolutely flat. A couple of these stocks like Panacea Biotech are seeing big moves on the upside. So Panacea is up almost about 12% as that India RF, which is promoted by Piramal Enterprises and Bain, has invested almost 1,000 crores into Panacea Biotech. So that's the stock that's really breaking out right now. And a couple of these smaller banks, not just Lakshmi Vilas Bank, that's up about 3%, but Dhanlakshmi Bank continues to move up higher, and Delta Corp had very good numbers, so that stock is also trading in the green.
Fair point. Flat as far as the index is concerned, but you have these little gems here and there. No, Sandeep, that question to you. Would you worry that the debt market can still throw up some ugly shocks, or do you think that chapter is largely behind us?
Well, I think to a large extent we can say, and I say hopefully say, that the chapter is behind us. But like the shocks in corporate balance sheet, they always hit you when you least expect it. So I think going by that adage, I think something else could also be coming up post the election. So I won't be writing it off as it.
Okay, well, the pre-open is settling now. IOC, HPCL, BPCL. Let's see how much more downside, because obviously crude prices going up almost on a daily basis, but it's not translated into pump prices ahead of elections. So post-election there would be a hike, but till then there could be some underperformance. Also, Sun Pharma is actually down about 1% in pre-opening, so that's also an interesting stock to watch out for. Tata Motors not as down as we thought it would be, especially looking at the ADR performance as well. And a couple of other stocks like Dhanlakshmi Bank also looking quite interesting. DLF, any thoughts on this stock, Sandeep?
Well, I think the real estate major is really taking efforts to realign its balance sheet, and the main fact is I think there is still substantial appetite for paper at this juncture. So in a way it is good for the sector as well as for the large players, because appetite for paper hasn't waned apparently.
Okay, well, the top Nifty loser right now is Asian Paints. It's down about 2%. If you're wondering why, our colleague Mangalam is here to tell us a couple of reasons. Mangalam, CLSA has downgraded the stock today.
Absolutely, and there are interesting reasons for the downgrade, Sonia. It's a treble trouble, if you must, for Asian Paints. CLSA says they see risks to the consumer demand right now, so revenue risk. And add to that, it is happening at the time when crude prices are inching higher, so there's margin risk. And all of this at a time when the company is trading, the stock price is trading at a record high, so there is valuation risk as well. So they say there is a risk to valuations given the recent weakness that we're seeing in consumer demand, which is witnessed in the sort of auto sales numbers that we're getting. Along with that, even the consumer discretionary companies who are talking about all these things. All of this at a time where crude prices are inching higher. TO2 or titanium dioxide is a key raw material for all these paint companies. They're a crude derivative, so that moves higher as well. They have pruned their EPS estimates by about 2 to 5%, mainly led by revenue. But all of this treble trouble falls very little in terms of price target. So they've cut their price target from 1565 to 1400, and the stock price is currently at 1500.
Okay, Mangalam, thanks a lot for that. So that's the stock to watch out for. Down quite a bit in pre-open, down about 2%. Let's take the 9-10 calls then. Pre-open has settled 56 points higher on the Nifty Bank and 7 points higher on the Nifty. Ashwani, is there an index trade or would you avoid it? And what's the 9-10 call?
See, the index trade is basically trying to catch a retest of yesterday's low, which was 11,550 thereabouts. I would think that after the initial downside, there could be upside which could be happening, and that will lead to short covering. So wait for the market to decline about 50-70 points. Also on Bank Nifty, again, you could have a 100-point downside which gets bought into. Individual stocks, BPCL is a sell with a stop of 356, target of 340.
Okay. Sudarshan?
Well, I don't have a view on the index except for the levels 11,550. If it holds, there are intraday trades. Ashwini spoke about it. If it doesn't hold, there is a positional short on also. Hind Petro is a short sell. 258 as a stop loss and 245 as a target.
Okay, Mitesh, what about you? What would the big call be at 9:10 this morning?
I will choose a mid-cap stock, Jacob. That's a buy with a stop at 116 for targets of 141.
Okay, Sandeep, sorry. I just wanted to ask you, we spoke about Asian paints. Paint, cement, home improvement, buys in any of this? Or generally, you're not a buyer at all, now you want the dip?
Well, I think you could have a good dip and that could lead to some opportunities. But Lata, one should be always mindful of the fact that household derivatives, what you have spoken about, or this kind of home improvement, I think over the last 15-year basis, they have given some of the best CAGR, right from the top end of the 1 lakh crore market cap coming down all the way to 5,000 crore market cap. Stories abound there, and this is one segment or one sector which, if somebody wants to make good money over an extended period of time, you have to buy into dips into this sector.
Okay, Sandeep, pleasure having you with us today. Thank you very much for joining us.
Okay, well, thanks Sandeep for being with us. Oil marketing companies continue to move lower. Of course, higher crude prices having a negative impact on a whole host of sectors. So let's find out what the latest is in the crude market. Manisha Gupta joins in for a roundup of all the action there. A 5-month high for crude, Manisha?
Well, yes, November highs, and we've been talking about this for some time. The first quarter has ended well, and the second quarter is maintaining gains or building gains onto that one. And even as we hold $71 for the Brent prices, 31% up for this year, there are expectations that you are working towards $75 at least for the Brent prices in this quarter itself. The US crude oil prices also now are inching towards 65, 41% of gains in this year until time. Markets, of course, have been working with the OPEC-led output cuts, also preparing for harsher sanctions now on Iran and Venezuela from US as it comes down for reviewing for the next month. And now it also is about Libya unrest and the supplies that could decline from that major oil producer as well. All of these factors really working well. Fundamentals are strong, and you have seen more and more money riding on of these fundamentals, and that keeps the net long positions on a high, and we have seen the prices continue to move up. It also has to do with the China stimulus measures. In the last 24 hours, we have heard about China relaxing residency curbs in smaller cities. There is more financing now coming in from smaller and medium level of businesses, and also increase in the infrastructure spending to boost economic growth. So these are some of the things that China has been doing in last couple of days, and that has led the metal prices on the higher side. So everywhere you look, whether it is zinc or copper or the iron ore prices, which are trading at a 5-year highs, it has been going good in the metal space as well.
Okay, Manisha, thanks a lot for joining us. Panisha Biotech, of course, will be one of the stocks to watch. That's up about 14% in pre-open. And on the downside, Ashwini, your thoughts on Sun Pharma? Technically, how's it looking?
See, basically, it's moving sideways. It's not following. Neither is it going up. I think as a group, you probably want to look at things like, Oro Pharma, etc., which are showing much more strength than a Sun Pharma, which is basically the low was 400, the high is 500. It's just had a 20% rally over this entire period.
Okay. Well, we are counting down. Mitesh, is there anything that you want to train our eyes onto?
Lata, I would, not maybe in the beginning of the day, but during the day, I think I would want to keep a watch on Nifty IT. I think it's on the verge of breaking out to fresh swing highs, and that could be very interesting. If the entire index breaks out, then stocks like HCL Tech, Infosys, TCS, Tech Mahindra could rally a bit.
Yeah, there is 69.71 on the currency now, which would be a near-term low for the rupee. But let's wait and see if it continues that way. Yes, there goes the bell, and it's a very flat start, almost a comatose start. It started about 4 points higher. Now it is 2 points lower on the Nifty vis-a-vis yesterday's close. Likewise for the mid caps, it's flat as flat can get. 1 to 3 points down on the index. The Sensex is up 0.1, if you please. That's 35 points. 38,735 on the grand old index. The Nifty is just given up 11,600 by a smidge. 11,599. The Nifty Bank has also dipped a little bit, oh so little bit, into the red, 0.11%, and that's 32 points lower, 29,800 or thereabouts. It's easy to tell you the list of gainers. Nothing is over 1% higher. I mean, Bharti Airtel is up about 1.4%. Otherwise, Z, Infosys, Tech Mahindra, I mean, the tech stocks basically, Infosys, Tech Mahindra, HCL, Tech Wipro, are all up about 0.5% or even less. And then there's HUL, Britannia, the FMCG companies, which are marginally in the green. Oh, so marginally. The red list is longer. Asian Paints is the biggest loser, not by a whole lot, 2.3%. And then there's BP, HP and IOC down about 1.5%. Sun Pharma is still negative, 1%. GAIL, 0.7%. Kotak Mahindra, 0.7%. So these are not really seeing, although they have got some positive news, some of them, nothing much is happening to the stocks. Bajaj Finance, Adani Ports, Tata Motors, Grasim, even Tata Motors has not lost a whole lot considering the gravity of the news. Down about 0.7%, IndusInd about 0.5%, Reliance about 0.5%. It's a long red list, and now the cuts have gotten a little deeper at the index level. 0.25% for the Nifty, a third of a percent for the mid caps, and another 0.25% for the Nifty Bank.
Okay, well, it's a weak opening for the mid-cap index, down about 70-odd points. The market breadth is in favor of advances, but the index itself is down 0.3%. A lot of the newsmakers of yesterday are correcting today. So Lakshmi Vilas Bank is seeing some profit taking, down about 2.5% after that deal with Indiabulls Housing. NIT Limited is seeing some profit taking after that deal with Bearings. It's now down about 2%. All the oil marketing companies are under pressure because of that surge in crude prices. So HPCL, IOC, BPCL all under pressure. Dhanlaxmi Bank had a big run-up yesterday, sentiment impact after the LVB deal. So that stock is down almost about 5.5% right now. And talking about some of these crude reactions, you're seeing it on some of the tire stocks as well. The likes of Seat, Apollo Tyres, etc. Either flat or in the red. Seat, in fact, is down almost 1.5%. Apollo Tyres is down 1.5%. Synthetic rubber is a big raw material for them, and because of the spike in crude prices, they're facing higher raw material costs. A couple of stocks on the upside. Panacea Biotech, of course, on getting that 1,000 crore funding from the Piramal Fund. Panacea Biotech is up almost 15% right now. And a couple of other stocks that are looking good. You have DLF, that's up in the news, up about 1% Jet Airways making a tad bit of a comeback, but pales in comparison to the fall that we've seen. And something like an ITI is up about 5% or so. Otherwise, Anuj, it is a market that's struggling a little bit at these levels. Especially the mid-cap index is a bit of a come-off there.
Oh, yes, it has. And, crude is clearly the theme today. Paint, tires, oil marketing companies, that's the space which is going down. Asian Paints, of course, post that downgrade, down 2.5%. I think it's got Berger Paints for company. That's also an expensive stock. So, that whole sector, you're seeing quite a bit of decline because of that. There's, a bit of a problem with the market. I'm just looking at some other, stocks. Chennai Petro is a bit soft. NIT Tech continues its correction. Indiabulls Housing is continuing with its correction. So let's see how things move. For now, the market, I think, is trying to take some support once again at yesterday's low and is seeing a bit of a bounce from those levels. Ashwini, is there a trade on the index or any individual stock?
See, I was looking to buy a retest of yesterday's low. We pretty much have got that. So my sense is that given we had a big fall yesterday, plus again big fall today, if you buy here, you could get back towards 11,700, 720. So this is the exact low of the range which people should buy if they are interested in playing the range. I don't think this sort of fall is likely to sustain all day.
Okay. Mitesh, what would your trades be now? Is there an index trade? Is there a buy on dips?
Lata, sorry. We bought the index around 11,560 yesterday. I think that remains the buying area with a 35-point stop. There about not much happening on the stock, individual stock specific side, but I think a couple of PSU banks have retraced in our support areas. Stocks like State Bank of India, Bank of India. I think these stocks I would want to focus upon, but I'm not initiating a buy right now. Maybe first half an hour will possibly give us more confirmation of some kind of bounce coming in over here.
Okay, well, this crude theme is definitely playing out. So paint companies like Asian Paints and Berger Paints are down in the red. You have tire companies like Apollo Tyres, which are the big losers right now, and oil marketing companies, IOC, BPCL, all down about 1%. Sudarshan, just quick thoughts from your end before we end the discussion. Any of these stocks, crude related, that you would trade either on the upside or the downside?
No, you have to trade it on the downside. Apollo Tyres and C8 are both available for short selling as we speak for the day. And unfortunately, Reliance, which is very crude sensitive, is not doing well. So I would be very careful of this market.
Okay, Mitesh, any other stock that's on your radar? By the way, Tata Motors has moved into the green already. Perhaps that bit of a consensus on that didn't work. So that one already into the green. Just keep an eye on that stock. Mitesh, this one or any other stock?
So I like Tata Motors and DVR, both of them. And that apart, I think, I was talking about IT and Wipro is trying to break on the upside. If it starts getting past 267, 268 and is practically just 2 rupees below that, I think that could add some more strength on the upside.
All right, gentlemen, thank you very much for being with us through the pre-market and the early minutes of trading. We're going to come back and ask you questions at 10 a.m. for your 10 a.m. trades. Well, our market master is waiting by, but we just have a CNBC-TV18 exclusive to attend to. Abhishek Kothari learns from sources that SBI is likely to launch a QIP sometime soon. Abhishek, tell us the details.
Well, Lata, sources tell CNBC-TV18 that SBI is likely to launch its QIP this week. So the bank is looking to raise anywhere between 10,000 to 15,000 crore rupees. And the issue, that is the QIP, could be priced between 295 to 305 per share. So if you look at the book value of SBI, 9 months on a consol basis is close to around 260 rupees per share. And if you do a math in terms of 6 months average price, that works out to close to 286 per share. The capital infusion can improve the consolidated tier 1 ratio of the bank by 75 basis points to around 11.44%, not taking into consideration the Q4 profits. So the bank already has a board approval to raise funds up to 20,000 crore via equity issuance up to March 2020. We wrote to the management and management has declined to comment on market speculations. Back to you.
All right, Abhishek, thanks a lot for giving us those details. That's SBI now at high point of the day. Let's do one thing. Let's thank our technical experts on that note. Ashwini, Sudarshan, Mitesh, thanks a lot. We'll keep coming back to you, of course, through the day. Sridhar Shivram is with us, Investment Director of Enam Holdings. Sridhar, good morning. Thanks a lot for joining us. Your thoughts on the recent market move post Balakot? We had that surge, but that coincided with, of course, global markets also moving up, emerging markets. But now we're seeing a bit of a fatigue. Your thoughts on the overall move?
So my broad view is that post what happened to the way Fed has given their broad indication of not incremental anymore cuts, those are normally very good for emerging markets, and we've seen a huge emerging market rally. India hasn't participated as much. As of yesterday, emerging markets are up almost 13-14%. China is up almost 22%. We are up 5-6%.
From?
This is year to date.
Ago.
Yeah, year to date numbers. So, and broadly, if you look at across the board, most markets are up 10-12%, a few barring here and there. So I think there's a catch-up trade for India. So India has their own issues. I mean, beginning of the year, some of the NBFC issues were plaguing the markets. Plus, we have an election coming by. So I think once the dust settles down, we'll see that India will participate far better than what it has participated right now. So we remain positive on the markets. We think this is a global environment which is conducive for emerging markets in general, and India would participate eventually.
Okay. India is also one of the better valued markets, even when it is in a downturn and not getting the benefit of FII flows. Now, how would you rate the earnings season that's just ended and the one that we are now in? Do you think that can spook investors, or do you think things are on the mend?
So I think the earnings are going to be mixed. So we know already that discretionary has taken a hit. And whereas financials may show slightly better results because of reduced credit costs that they will have. So I think the earnings are broadly priced in. I don't see too many surprises as far as earnings is concerned. What has also happened is that many stocks have corrected. If you take 1 year back prices, barring a bunch of 10 stocks, you take the rest of the market, they've had a significant correction. So your risk reward is slightly better right now, keeping a view that some of them may be a cyclical trough that you're going through, and it is up to investors to take a constructive view based on whatever assumptions you can make and build a portfolio for the next 3-4 years. It doesn't mean that if you buy today, the earnings are going to come tomorrow, especially for a lot of the cyclicals and discretionary. But based on historical, assumptions and data that you have, it always plays out well when you buy good companies when cyclically they are at a low.
Did I hear Maruti in between?
I didn't say much. I don't want to talk about stock specific, but auto surely is something that is worth looking at.
Maybe by the end of this discussion, we might try and get some stocks out of you. I won't promise that to our viewers. But nevertheless, just keep an eye out on the markets, because there's a bit of a recovery that the market is attempting right now. And the stocks that are batting for the bulls are the banks. ICICI Bank is up almost 0.5%. SBI is up almost about 0.3%. So looking okay from the financial end. I mean, that at least keeping the market afloat at the moment. But Sridhar, hi, morning. You mentioned that the NBFC crisis is something that is still a bit of a problem.
Right.
Do you think that could mean more market share for banks, and would you put more money to work in the banking space?
Yeah, so we've been very positive on banks for the last 18 months, especially the corporate banks. I think a lot of it is played out. We've seen significant rallies in some of the corporate banks, so I would have to admit that it's a consensus trade right now. But having said that, the way NBFCs have behaved and the entire crisis is evolving, and we are seeing some of them wanting to, merge with banks. We've already had two instances in the last 1 year. I think the writing is already on the wall that for a long-term sustainable business model, the NBFC model cannot sustain after a point of time. That if you cross 1 lakh crore of assets, it becomes that much more difficult. So I think the banks are in a sweet spot right now where NBFCs are really wanting to figure out if the business model is correct. The growth rate that NBFCs are having of about 30-40% is, I think, something of the past, and they'll have much more muted growth. As a result, the banks will have a good time. The other thing I hear from banks is that the pricing has improved. Because the NBFCs are so aggressive, they were actually, very aggressive on the pricing. So that has abated. So broadly, I would say it's looking good for banks in general.
One sector which has made a comeback, it's not a big sector, but there are some big stocks here. There's real estate, Godrej Properties, DLF has made a comeback. There's South-based real estate stocks anyway have done well. Is it worth looking at the sector?
My view is that the commercial end of the real estate is looking really good. And if somebody wants to play the real estate, I think the REITs is a very good option. We already have one listing on that, and I'm sure there'll be more listings. And generally, when I speak to people in the real estate, the sense we get is that the supply on the commercial space is much more restricted than on the residential space. So I'm not a bull on the real estate stocks as such, especially because a lot of them have a huge residential component to it.
Okay. Which part of the financials are you playing? You said that you're not confident of NBFCs,
right,
though some of them have managed themselves beautifully, especially consumer finance guys.
Yeah.
But any part of NBFCs, but more importantly, which ones would you want to buy?
So in the financials basket, banks surely.
I mean, see, there are these mid-caps and small caps which we don't talk about at all.
Yeah.
I mean, it's always HDFC, Kotak, SBI, ICICI, Axis. What beyond that? No.
So I think I think the differentiation between a consumer and a corporate bank is fading. Now, the consumer banks that we used to say are no longer consumer. And the corporate banks that we normally refer to are no longer corporate because they also have consumer. So I think it's for people to, do their own analysis. But banks as a space is looking fairly good. as long as you do your due diligence, because...
Will you buy the top 5 or will you go down the pecking order for whatever reason?
I think you can go down the pecking order. There's no issues going down the pecking order because they have a business model also. And some of them are trading at much far better valuation. In fact, we are also open, I mean, we do have exposure even to the PSU banks, especially the top 2-3 PSU banks, because they have similar plays, which is that credit cost is coming down and the opportunity for them also is looking good. On the NBFC side, you know, the consumer-facing NBFCs are far better placed than the ones who have a large exposure to even corporates. So I can't understand NBFCs wanting to lend to corporates, which the banks can anyway lend. So you're borrowing from a bank and then lending to a corporate and competing with the same. So that business model, I think we tend to avoid. I know there are fans to that, but yeah.
Okay. So that point is taken, that you stay away from NBFCs and stick with the corporate-facing banks. What about discretionaries? I know you've said in the past that the best time to buy autos is during distress.
Yeah.
Would you buy the larger names like the Hero Motors of the world, or would you now get into the smaller auto ancillary companies?
So discretionary, we are bullish both on auto and auto ancillary because we think that this is a cyclical phase that they are facing. So when the autos go through cycles, the ancillaries obviously have the same pain. But we think that the cycle will turn maybe in 12 months, 6 months. We don't know the exact time. But a lot of them are trading at, you know, very attractive valuations. When you look at a 10-year chart and look at the valuations where they are, they look very attractive right now. So discretionary, not only auto, even media, which also falls in discretionary, is something that we are quite bullish on because a lot of them are cash flow rich companies. And because of the fear of OTT and many of the other innovative changes that are happening, the valuations have come down significantly. And they have no debt, they have a brand. So I think that's the other part within the discretionary that we like.
Okay, you know, your thoughts overall on the broader market. We had a big rally in 2017. You know, some part of it was cost of capital rally, some because, you know, post demonetization, a lot of money moved into mutual funds. Then we had that sharp correction last year. You reckon we could have a outperforming broader market this year towards the end, second half?
Yeah, if I were to guess, I think the broader market will outperform this year. I think 2017 was an exceptional year. I think even some of the newer people who came into the market thought that they were better than Warren Buffett because every stock they touched, everything was doing well. And I think 18 was a reality check. So I guess it's good for the industry as such because many people haven't seen cycles. So when you go through cycles, you know that this is something very normal and you have to, you know, insulate your portfolio to such events. So I think 2019 is going to be a fairly good year. When we end the year, we'll have more smiling faces than what we had when we ended the year of 2018.
Okay. But when do you see consumption picking up? I guess much of this discretionary consumption downtick has a relation to the way NBFCs have done and even generally the liquidity in the system. Because there is going to be a Fed balance sheet reduction ending. Actually, by May itself it ends and September it ends completely. Do you think that you could start buying for an uptick in consumption in the second quarter, or will it be second half? I mean, basically, is consumption going to pick up in FY20 itself?
So I'll have some answers in 3 weeks because I'm doing 3 road trips in the next 3 weeks. So I'm in Tamil Nadu next week, MP the week after, and UP the week after that. And the idea is to do on-the-ground check on auto, cement, consumer discretionary, what's happening, speak to people. So in 3 weeks' time, I'll have more answers to this as to why consumption has come off and when will it pick up.
And the idea is
the third week. The third will be first week of May is your UP trip?
End of April.
Okay, so give us a commitment that you will be with us in the first week of May to tell us how the trip was.
So I think once we are able to collate all the data, surely we'll
closer to the election outcome as well, so you can give us a feeler of what's happening on that front too.
Yeah, we'll get some feelers, but I guess these road trips will not give a conclusive view anyway. This is a broad view to get an idea of what's happening on the ground.
Okay. But you are bullish on a space like cement, right?
Yes.
I mean, you've said that in the past.
Yeah.
You've mentioned to me names like Dalmia Cement, Star Cement are stocks that you like. But what is it? Is it that pricing has picked up, capacity utilization has picked up? What's your base case?
So it's a combination of both. Pricing has picked up, capacity utilization has moved up. also the prices have come down. So your risk reward as an investor is improved as far as cement stocks are concerned. Okay. So I think it's a combination of all three. We do think that because of all the road projects, the infra projects, you look at Mumbai and you think it's city under construction. But all this has an impact on the cement demand. Same is happening to at least 20 different cities where metro construction is currently going on. So I think these are good for cement. So we do think that cement capacity utilization comes closer to 80%. It has a huge impact on pricing.
I know there was someone who said that in Bangalore, in India you drive on the left of the road. In Bangalore you drive what is left of the road. So I mean it is happening
Not
everywhere.
too different for Mumbai. Right?
Yeah, absolutely. You drive even on the footpath here. Okay, I just want to finally ask you, a sector that you seem to be bullish on, which is,
cement?
Infra.
Yeah.
You have GMR Infra, I think, in your holding. Now, that's a bold call. You think that this 10-year pain is over and you will start looking at power, infra, such kind of companies?
So I'm not commenting whether we have it or not. Okay. It's in general, we like the airport space. So that's the whole play, that if you look at the aviation growth that is happening in terms of passenger growth, that's a very interesting space which is emerging. And especially if there is a exclusive airport play, it makes it very interesting because they'll have a secular growth and the valuations are looking quite compelling.
Okay, well, in fact, we were just talking about the auto ancillaries. One of the top picks that you had at least spoken about in the past in the auto and auto ancillary space is Sandhar Technologies. So we've invited the management.
Sure.
You're free to listen into the conversation, ask questions to the management if you want. Their company has actually been outperforming with a 20% revenue growth versus 10% for the industry. And they supply to large two-wheeler players like Hero MotoCorp, etc. So they'll be able to give us a ground check of how things are shaping up. Arvind Joshi, the whole-time Director of Finance of Sandhar Technology, joins us now. Mr. Joshi, good morning and thanks for joining us. First, if you can just start by telling us what is happening on the ground to players like Hero MotoCorp. We understand that inventory levels are as high as 150 days as well for some of them. How high is the inventory level at your end? And have you been cutting down production in order to rationalize it with demand?
At the outset, I must say good morning everyone at the studio. Thank you for giving me the opportunity to explain about what's happening on the ground. I'm sure this is the toughest period for every auto ancillary as well as auto sector player to answer questions to the media. But certainly at the ground level, I would certainly say yes, the market sentiments are down. People are playing on the uncertainty, which means there is a pessimistic opinion about the auto sector. But certainly at the ground level, we don't feel that much amount of pinch. Yes, it's true that in the last 18 years, the quarter four was the first time that the quarter four was just contributing about 20% to the overall revenue for the full year. And this ensured that, the H2, which typically tends to be a 52% revenue contributor for the whole year, has come down to just about 45%. Having said that, I think for us, there's no inventory pile-up as such because we operate on just-in-time inventory basis. So we are very well integrated with the supply chain of the OEMs. So for us, it doesn't make much of a difference. However, yes, it's true that some of the major OEMs have cut down on their production and the schedules also. And this definitely impacts the overall growth of the company, which what we would have assumed to be in high teens might come down to somewhere in between 10 to 15% for the full year.
10 to 15 we could take with both hands if it happens. Mr. Joshi, I'm not only asking about your company, but basically are you getting a sense that the inventory drawdown is underway and there are at least some footfalls coming in with Gudi Padwa and the summer starting? Any hope that the darkest period is over?
I think yes. With the election results out, I probably feel that the market is again going to be on the upside. There's no reason. These are cyclicality things, and of course, with the macroeconomic factors,
Mr. Joshi,
certainly it does impact the auto sector consumption. Yeah,
Mr. Joshi, is this a hope? I mean, I feel that after elections it will happen, or are you actually seeing footfalls in April better than in March, or in March better than in Feb?
See, I think, what we really need to look at is, we need to dissect the whole auto sector. Every particular segment in the auto sector plays out in a different manner. Two-wheelers would play out in a different manner. There have never been a time when two-wheelers, passenger cars, commercial vehicles, all the sectors have played off, full cylinders. Sometimes you see a two-wheeler dip and sometimes you see a passenger vehicle dip. Registering a 17% plus growth on the commercial vehicle side was something unheard of in last almost about a decade or so. And so I think we will have to dissect each of the segments. We are pretty bullish on the two-wheeler segment. As well as on the passenger cars, yes, there would be a slowdown certainly for the first half, but I think most of the OEMs would want to rejig their strategy as to when are they going to launch the BS6. Our gut feeling is that we would see BS6 launches happening in Q3 itself rather than waiting for Q4.
Okay, you are also...
So all in all, I would say we find ourselves into a...
Sure.
Yeah.
No, you spoke about two-wheelers and four-wheelers. You're also one of the largest manufacturers of operator cabins in India, excavators as well. You supply to names like JCB, Atlas Copco, etc. What's happening in terms of industrial demand? Has there been a slowdown there, or do you see a pickup? What kind of growth rates are we looking at?
No. Well, certainly, the construction equipment sector has been growing like anything. We registered almost about 70 to 75% growth in the last fiscal we just ended, and we are not seeing any slowdown whatsoever in the construction equipment sector. Of course, with the election results not ensuring stability in the new government, certainly it's likely to be impacted. But as of now, we have, for the full year, we are completely choked and we are looking at almost about 40% plus growth rate on the construction equipment sector also.
All right. We'll leave it at that, Mr. Joshi. It was a pleasure having you with us. Thank you very much for giving us a ground check on how things are panning out. But it is an important takeaway that a person from the industry believes it's a passing phase and post-elections he should expect something better. You agree, Sridhar?
Yes. Okay. I think on consumption, we surely hope that things will improve. And based on past historic data, I think the cycles turn, and when they turn really fast. It's very difficult to catch them at that time.
His last point that he made, there's no slowdown in the construction equipment sector. Would you take that with a pinch of salt?
No, I think that's what we are actually seeing right now because of the pent-up orders. So if you look at the order pipeline that we have for roads and many of the other construction projects, they are actually quite good. So the impact of that happens with a lag, which is, say, with a 12-month lag, which is what is currently happening. The new orders are slowing down. So we will see an impact of this maybe in with a lag, which is, say, in 9 to next 18 months, we'll see a pocket where the construction demand will slow down because of the lag in orders. But currently, the order execution is at full swing.
Okay. At the moment, what are you looking at earnings growth for FY20?
I think
FY18, I think FY19 is 8-9%.
Yeah, I think keep in mind that financial will have a disproportionate earnings just because of the way the base is. So that will skew. I think I'll be surprised if we don't get on an aggregate basis at least 17-18% because financials will dominate that.
This is the 6th year I'm hearing that number. Thank you very much, Sridhar Shivram, for being with us. It's always a pleasure. And remember, you have given us a public promise to be with us in the first week of May
I'll try my best.
After your perambulations.